Hello, everyone, and welcome to this detailed breakdown of the One Big Beautiful Bill, a massive piece of legislation that could transform taxes, healthcare, and more for millions of Americans. Spanning 47 pages, this bill covers everything from tax cuts for families to support for rural businesses to immigration policies. Today, we will walk through each section, compare it to how things work now in 2025, and explain what it means for you, your family, or your business. This is a comprehensive overview, so grab a snack, get comfortable, and let's dive in. Let's start with the first major section, which focuses on putting more money back in the pockets of families and workers through tax relief and support programs. Subtitle A: Make American Families and Workers Thrive Again. This subtitle aims to provide permanent and temporary tax relief for American families and workers, making it easier to save, spend, and thrive. It's divided into parts, starting with preventing tax hikes and adding new deductions and credits. Part 1. Permanently preventing tax hikes on American families and workers. This part focuses on locking in tax cuts from the Tax Cuts and Jobs Act, or TCJA, to avoid tax increases that would hit after 2025. In Section 110001, titled Extension of Modification of Rates, this section locks in current tax rates from the TCJA to prevent increases after 2025. The bill states the following: the current law, as it stands in 2025, sets individual income tax rates, such as the top rate of 37%, to revert to pre-TCJA levels, like 39.6% for the highest earners, after 2025. This would mean higher taxes for most income levels. The bill makes these lower TCJA tax rates permanent, ensuring they don't increase. It also adds an extra year of inflation adjustment for all tax brackets except the top one, keeping them aligned with rising costs. This affects most taxpayers, particularly middle and lower income earners who benefit from lower rates. You'll likely keep paying lower taxes, and most brackets will adjust for inflation, meaning more of your income stays tax-free over time. However, high earners in the top bracket won't see inflation adjustments, which could slightly increase their tax burden as inflation rises. This provision aims to provide tax certainty, but may reduce federal revenue, potentially impacting the budget. For example, in 2026, under current law, tax rates would be 10% for the first bracket, 15% for the second, 25% for the third, 28% for the fourth, 33% for the fifth, 35% for the sixth, and 39.6% for the top bracket. With this bill, the rates stay at 10%, 12%, 22%, 24%, 32%, 35%, and 37% for the top bracket. In Section 110002, titled Extension of Increased Standard Deduction and Temporary Enhancement, the bill extends the TCJA's doubled standard deduction permanently and boosts it further for 2025 through 2028. Currently, in 2025, the standard deduction is about $29,200 for married couples filing jointly and $14,600 for singles. Without this bill, these amounts would drop to roughly half after 2025. The bill keeps these higher deductions and temporarily increases them by an additional 10% during those years. For a family of 4, this could mean an extra few $1,000s tax-free each year, putting more money in your pocket for groceries, bills, or savings. However, the temporary boost ends in 2028, so plan accordingly. This helps most taxpayers who don't itemize, but it might reduce federal revenue, potentially affecting public services. In Section 110003, titled Termination of Deduction for Personal Exemptions, the bill permanently eliminates personal exemptions. In 2025, current law would reinstate exemptions, about $4,700 per person, after the TCJA suspended them. This bill keeps them gone, streamlining the tax code, but potentially disadvantaging larger families. However, the increased standard deduction and child tax credit aim to offset that loss. It streamlines tax filing but could hit bigger households harder unless they qualify for other credits. In Section 110004, titled Extension of Increased Child Tax Credit and Temporary Enhancement, the bill permanently extends the TCJA's $2,000 child tax credit, indexes it for inflation, and temporarily increases it to $2,500 from 2025 to 2028. Current law would reduce the credit to $1,000 per child after 2025. This means families with kids under 17 get more tax relief, potentially $500 more per child during the temporary period. For example, a family with 2 kids could see an extra $1,000 annually, helping with school supplies or childcare. The inflation indexing keeps the credit's value over time, but the temporary boost ends in 2028, so families should budget for that. This supports parents but reduces federal revenue. In Section 110005, titled Extension of Deduction for Qualified Business Income and Permanent Enhancement, the bill permanently extends the TCJA's 20% deduction for qualified business income and increases it to 23%. In 2025, this deduction, for pass-through businesses like sole proprietorships or LLCs, would expire without the bill, raising taxes for small business owners. This change means if you earn $100,000 in qualified income, you could deduct $23,000, saving you thousands in taxes. It encourages entrepreneurship and small business growth, especially for self-employed individuals, but it could strain federal budgets due to lower tax revenue. In Section 110006, titled Extension of Increased Estate and Gift Tax Exemption Amounts and Permanent Enhancement, the bill permanently extends the TCJA's higher estate and gift tax exemptions and raises them to $15 million for individuals and $30 million for couples starting in 2026. Current law in 2025 sets the exemption at about $13.6 million per person, dropping to around $7 million after 2025. This bill benefits wealthy families by allowing larger tax-free transfers of wealth, reducing estate taxes for high-net-worth individuals. For most Americans, this won't apply, but for business owners or farmers with large estates, it could mean significant savings. Critics argue it widens wealth inequality and reduces federal revenue. In Section 110007, titled Extension of Increased Alternative Minimum Tax Exemption and Phase-Out Thresholds, the bill permanently extends the TCJA's higher AMT exemptions and phase-out thresholds. In 2025, these would revert to lower levels, increasing AMT liability for some upper-middle-income earners. This keeps more households, especially those with incomes between $150,000 and $400,000, from paying the AMT, simplifying their taxes. For instance, a family earning $200,000 might avoid several thousand in AMT under this provision. In Section 110008, titled Extension of Limitation on Deduction for Qualified Residence Interest, the bill permanently extends the TCJA's cap on mortgage interest deductions at $750,000 of mortgage debt. Current law would raise the cap to $1 million after 2025. This limits deductions for high-value home buyers, affecting wealthy homeowners in expensive areas. If you have a smaller mortgage, this won't impact you, but it could make big homes less tax-advantaged. In Section 110009, titled Extension of Limitation on Casualty Loss Deduction, the bill keeps the TCJA's restriction on casualty loss deductions, allowing them only for federally declared disasters. Current law would allow broader deductions after 2025. This simplifies taxes but may hurt those with uninsured losses outside disaster zones, like fire or flood victims in non-declared areas. In Section 110010, titled Termination of Miscellaneous Itemized Deduction, The bill permanently eliminates miscellaneous itemized deductions, like unreimbursed employee expenses, which current law would restore after 2025. This simplifies the tax code, but removes benefits for some workers, like teachers paying for classroom supplies. Other deductions may offset this loss for most. In Section 1.10011, titled Limitation on Tax Benefit of Itemized Deductions, the bill extends the TCJA's limits on itemized deductions for high earners, which would otherwise expire. This caps tax benefits for those with incomes above certain thresholds, targeting wealthy taxpayers. It keeps the tax code progressive but may discourage charitable giving among high earners. In Section 1.10012, titled Termination of Qualified Bicycle Commuting Reimbursement Exclusion, the bill permanently ends the exclusion for bicycle commuting reimbursements, which would return under current law. This removes a small tax break for eco-friendly commuters, likely affecting few people but signaling a shift away from niche benefits. In Section 1.10013, titled Extension of Limitation on Exclusion and Deduction for Moving Expenses, the bill extends the TCJA's limit on moving expense deductions to job-related moves only, which would otherwise broaden after 2025. This affects workers relocating for jobs, reducing their tax benefits unless employer-covered. In Section 1.10014, titled Extension of Limitation on Wagering Losses, the bill keeps the TCJA's rule that wagering losses can only offset gambling winnings, not other income, which would loosen after 2025. This impacts gamblers, ensuring losses don't reduce other taxes, maintaining fairness but limiting deductions. In Section 1.10015, titled Extension of Increased Limitation on Contributions to Able Accounts and Permanent Enhancement, the bill permanently extends and enhances the ability to contribute more to able accounts for disabled individuals. Current law allows higher contributions until 2025. This helps families save for disability expenses tax-free, improving financial security. In Section 1.10016, titled Extension of Savers Credit Allowed for Able Contributions, the bill extends the Savers Credit for able contributions, which would expire. This encourages low-income families to save for disability needs, offering a tax credit to offset contributions. In Section 1.10017, titled Extension of Rollovers from Qualified Tuition Programs to Able Accounts Permitted, the bill extends the ability to roll over 529 plan funds to able accounts, which would end after 2025. This gives families flexibility to repurpose education savings for disability expenses. In Section 1.10018, titled Extension of Treatment of Certain Individuals Performing Services in the Sinai Peninsula and Enhancement to include additional areas, the bill extends and expands tax benefits for military or civilian personnel in hazardous areas like combat zone exclusions. This supports service members, but has limited impact for most. In Section 1.10019, titled Extension of Exclusion from Gross Income of Student Loans Discharged on Account of Death or Disability, the bill extends the tax-free treatment of discharged student loans for death or disability, which would expire. This protects affected borrowers from unexpected tax bills. Part 2. Additional tax relief for American families and workers. This part introduces new deductions and credits to further reduce tax burdens, especially for specific groups like tipped workers, seniors, and parents. In Section 1.10101, titled No Tax on Tips, the bill creates a temporary above-the-line deduction for qualified tips from 2025 to 2028. Currently, tips are fully taxable as income. Under this bill, reported tips could be deducted, reducing taxable income for service workers like servers, bartenders, or delivery drivers. Only tips that are properly reported will qualify, which could create both incentives to report accurately and enforcement challenges for the IRS. For example, If you earn $20,000 in tips annually, this could save you thousands in taxes, boosting your take-home pay. However, it's temporary, so plan for 2029. This supports service workers but may complicate tax reporting and reduce federal revenue. In Section 110102, titled No Tax on Overtime, the bill introduces a temporary deduction for overtime pay from 2025 to 2028. Overtime is currently taxed as regular income. This benefits workers like nurses or factory employees who rely on overtime, letting them keep more of that extra pay. If you earn $10,000 in overtime, this could save you hundreds or thousands, depending on your bracket. It's a win for hardworking Americans but temporary, and it may strain federal budgets. In Section 110103, titled Enhanced Deduction for Seniors, the bill offers a temporary $4,000 deduction for taxpayers over 65 from 2025 to 2028. Currently, seniors get a small additional standard deduction, about $1,900. This new deduction could save seniors up to $800 annually in taxes, helping with retirement costs like health care or utilities. It's a significant boost for fixed-income retirees but ends in 2028. In Section 110104, titled No Tax on Car Loan Interest, the bill allows a temporary deduction of up to $10,000 for car loan interest from 2025 to 2028. Currently, no such deduction exists. This could save drivers, especially those with new car loans, hundreds of dollars annually, making car ownership more affordable. For example, if you pay $2,000 in interest, you might save $400 in taxes. It's temporary, so budget for post-2028. In Section 110105, titled Enhancement of Employer-Provided Child Care Credit, the bill enhances the credit for employers offering child care, increasing it and making it more accessible. Current law offers a limited credit, often underused. This encourages businesses to provide child care, helping working parents access affordable options. If your employer adds child care benefits, it could save you thousands in daycare costs, indirectly boosting your finances. In Section 110106, titled Extension and Enhancement of Paid Family and Medical Leave Credit, the bill extends and improves the credit for employers offering paid family leave, which would otherwise expire. This incentivizes companies to provide leave, benefiting workers needing time for newborns or medical issues. It could mean more job security and paid time off for you or your family. In Section 110107, titled Enhancement of Adoption Credit, the bill increases the adoption credit and indexes it for inflation. Current law offers a credit of about $15,000 per child, with limits. This makes adoption more affordable, potentially saving families thousands in tax liability, encouraging adoption and supporting growing families. In Section 110108, titled Recognizing Indian Tribal Governments for Purposes of Determining whether a child has special needs for purposes of the adoption credit, the bill allows tribal governments to certify special needs for adoption credits. This expands eligibility for Native American families, ensuring they access the same tax benefits, fostering equity, and supporting adoptions in tribal communities. In Section 110109, titled Tax Credit for Contributions of Individuals to Scholarship Granting Organizations, the bill introduces a new tax credit for donations to scholarship granting organizations. Currently, in 2025, no such federal credit exists, though charitable donations may qualify for itemized deductions. This bill offers a credit, likely up to a certain amount, for contributions that fund scholarships, making it easier for students to access private or specialized education. For you, this could mean a tax break if you donate to these organizations, encouraging support for education while reducing your tax bill. For example, a $1,000 donation might save you a few $100s in taxes, depending on the credit's design. This benefits donors and students but could reduce federal revenue and requires clear rules to prevent abuse. In Section 110110, titled Additional Elementary, Secondary, and Homeschool Expenses, treated as qualified higher education expenses for purposes of 529 accounts, the bill expands 529 plan uses to include elementary, secondary, and homeschool expenses. In 2025, 529 plans are mainly for college costs, with limited K-12 allowances up to $10,000 annually. This bill broadens what qualifies, potentially covering books, tutoring, or homeschool materials. If you're a parent, this gives you more flexibility to use tax-free 529 savings for your child's education, saving you hundreds or thousands over time. It supports school choice but may complicate 529 plan administration. In Section 110111, titled Certain Post-Secondary Credentialing Expenses, treated as qualified higher education expenses for purposes of 529 accounts, the bill allows 529 funds to cover post-secondary credentialing costs like vocational or certification programs. Currently, 529 plans focus on traditional college expenses. This change lets you use tax-free savings for trade schools or professional certifications, which could save you thousands on career training. For example, a $2,000 welding course could be paid tax-free, boosting your career without tax hits. This helps workers upskill, but may stretch 529 plan oversight. In Section 110112, titled Reinstatement of Partial Deduction for Charitable Contributions of Individuals Who Do Not Elect to Itemize, the bill brings back a temporary above-the-line deduction for charitable contributions for non-itemizers from 2025 to 2028. In 2025, only itemizers can deduct donations. This allows everyone, especially those taking the standard deduction, to deduct up to a certain amount, maybe $300, for donations. If you give to charity, this could save you a small amount in taxes, encouraging giving without needing to itemize. It's temporary, so plan for 2029. In Section 110113, titled Exclusion for Certain Employer Payments of Student Loans Under Educational Assistance Programs, made permanent and adjusted for inflation, the bill makes permanent the tax-free treatment of employer student loan payments, up to $5,250 annually, and indexes it for inflation. This provision, set to expire in 2025, allows employers to pay your loans tax-free. If your job offers this benefit, it could save you over $1,000 in taxes yearly, helping you pay off debt faster. It's a win for young professionals but depends on employer participation. In Section 110114, titled Extension of Rules for Treatment of Certain Disaster-Related Personal Casualty Losses, the bill extends the TCJA's rules allowing deductions for disaster-related casualty losses without the usual 10% income threshold, set to expire in 2025. This means if you face a disaster, like a hurricane, you can deduct more losses, potentially saving thousands in taxes. It helps disaster victims recover but may increase federal costs if disasters spike. In Section 110115, titled MAGA Accounts, the bill creates new MAGA accounts to encourage savings for education, entrepreneurship, or home ownership. There's no equivalent in current law. These accounts allow tax-free contributions and withdrawals for specific purposes, like a 529 plan, but broader. For example, saving $10,000 for a home down payment could grow tax-free, saving you taxes on earnings. This boosts financial planning but requires you to understand the rules to maximize benefits. It could reduce federal revenue due to tax exemptions. In Section 110116, titled MAGA Accounts Contribution Pilot Program, the bill launches a pilot to test MAGA account contributions, likely with incentives or matching funds. No such program exists in 2025. This could mean extra savings if you participate, especially for low-income savers, but it's experimental, so details matter. It aims to promote financial independence but may have startup costs for the government. Part 3. Investing in health of American families and workers. This part shifts to improving healthcare access and affordability, focusing on flexible health accounts and employer benefits. In Section 110201, titled Treatment of Health Reimbursement Arrangements Integrated with Individual Market Coverage, the bill allows health reimbursement arrangements, or HRAs, to cover individual market insurance premiums. In 2025, HRAs are limited to certain plans. This lets employers fund your individual health plans tax-free, increasing your coverage options. If your employer offers an HRA, you could save thousands on premiums, but you'll need to shop for plans carefully. This boosts flexibility but may complicate benefits administration. In Section 110202, titled Participants in Choice Arrangement, eligible for purchase of exchange insurance under cafeteria plan, the bill allows choice arrangement participants to buy exchange insurance through cafeteria plans. Currently, cafeteria plans have stricter limits. This means you could use pre-tax dollars for marketplace plans, saving hundreds or thousands on premiums. It helps workers afford insurance but requires employers to adopt these plans. In Section 110203, titled Employer Credit for Choice Arrangement, the bill offers a tax credit for employers providing choice arrangements. No such credit exists in 2025. This encourages businesses to offer flexible health benefits, indirectly helping you access better coverage. If your employer participates, it could mean lower health costs, but it depends on their uptake. In Section 110204, titled Individuals Entitled to Part A of Medicare by Reason of Age. Allowed to contribute to health savings accounts, the bill lets Medicare Part A enrollees contribute to HSAs. Currently, they're barred once enrolled. This allows seniors to save tax-free for medical expenses, potentially thousands yearly. If you're on Medicare, this could help with out-of-pocket costs, but you'll need an HSA-eligible plan. In Section 110205, titled Treatment of Direct Primary Care Service Arrangements, the bill treats direct primary care as a qualified medical expense for HSAs. In 2025, these arrangements are often ineligible. This lets you use HSA funds for subscription-based primary care, saving hundreds on routine visits. It supports affordable care but requires finding providers offering this model. In Section 110206, titled Allowance of Bronze and Catastrophic Plans in Connection with Health Savings Accounts, the bill allows bronze and catastrophic plans to qualify for HSAs. Current law excludes them. This means you could pair a lower premium plan with an HSA, saving on insurance while building tax-free savings. It's great for healthy individuals, but requires planning for higher deductibles. In Section 110207, titled On-Site Employee Clinics, the bill clarifies that on-site employee clinics are eligible for tax-free benefits. Some ambiguity exists in current law. This encourages employers to offer clinics, potentially saving you on doctor visits. If your workplace adds a clinic, it could mean free or low-cost care, boosting your health access. In Section 110208, titled Certain Amounts Paid for Physical Activity, Fitness, and Exercise. Treated as amounts paid for medical care, the bill allows HSA funds for fitness expenses, like gym memberships, up to a limit. Currently, these are not qualified expenses. This could save you a few $100s tax-free for staying active, promoting health, but requiring clear IRS rules to avoid abuse. In Section 110209, titled Allow Both Spouses to Make Catch-Up Contributions to the Same Health Savings Account, the bill lets both spouses contribute catch-up amounts to one HSA. Current law splits contributions. This simplifies savings for couples over 55, potentially adding thousands to your HSA. It's a small but helpful tweak for retirement planning. In Section 110210, titled FSA and HRA terminations or conversions to fund HSAs, the bill allows converting unused FSA or HRA funds to HSAs upon termination. Current law limits rollovers. This could boost your HSA by hundreds or thousands, giving you more tax-free medical funds. It's great for workers changing jobs, but needs clear rules. In Section 1.10211, titled Special Rule for Certain Medical Expenses Incurred Before Establishment of Health Savings Account, the bill allows HSA funds for pre-HSA medical expenses in some cases. Currently, only post-HSA expenses qualify. This helps new HSA users cover recent costs, potentially saving hundreds, but requires documentation. In Section 1.10212, titled Contributions Permitted if Spouse Has Health. Flexible spending arrangement, the bill allows HSA contributions even if your spouse has an FSA. Current law restricts this. This gives couples more flexibility, potentially adding thousands to your HSA, but you'll need to coordinate benefits. In Section 1.10213, titled Increase in Health Savings Account Contribution Limitation for Certain Individuals, the bill raises HSA contribution limits for some individuals, possibly those with high medical costs. Current limits are about $4,000 for individuals. This could mean thousands more in tax-free savings, helping with chronic conditions, but specifics depend on IRS rules. In Section 1.10214, titled Regulations, the bill directs the IRS to issue regulations for these health provisions. No equivalent exists in current law. This ensures clear implementation, helping you navigate new benefits, but delays could slow rollouts. We've covered how this bill helps families and workers thrive. Now let's move to Subtitle B, which is all about boosting rural communities and small businesses on Main Street, ensuring they grow and compete in today's economy. Subtitle B, Make Rural America and Main Street Grow Again. This subtitle focuses on tax relief and incentives to support rural areas and small businesses, from farmers to local shops. It's split into three parts, covering tax cut extensions, new relief, and health care for rural communities. Part 1. Extension of Tax Cuts and Jobs Act reforms for rural America and Main Street. This part locks in business-friendly tax provisions from the Tax Cuts and Jobs Act to keep rural and small businesses thriving. In Section 1.11001, titled Extension of Special Depreciation Allowance for Certain Property, the bill permanently extends the TCJA's 100% bonus depreciation for qualified property. In 2025, this allowance is set to phase out, dropping to zero by 2027. This bill keeps it at 100%, letting businesses deduct the full cost of equipment, like tractors or machinery, immediately. For a small business owner, buying a $50,000 machine could save you $10,000 or more in taxes up front, boosting cash flow. This helps rural farmers and shops invest, but may reduce federal revenue long-term. In Section 1.11002, titled Deduction of Domestic Research and Experimental Expenditures, the bill extends the TCJA's rule allowing immediate deductions for domestic R&D costs. Current law requires these costs to be amortized over 5 years starting in 2026, increasing tax bills. This bill keeps full deductions, so if your business spends $100,000 on product development, you could save $20,000 in taxes that year. It encourages innovation, especially for rural manufacturers, but could strain the federal budget. In Section 1.11003, titled Modified Calculation of Adjusted Taxable Income for Purposes of Business Interest Deduction, the bill permanently extends the TCJA's more generous business interest deduction rules. In 2025, the limit tightens, capping deductions at 30% of a stricter income measure, hurting capital-intensive businesses. This bill keeps the higher limit, so if you're a rural contractor borrowing for projects, you could deduct more interest, saving thousands. It supports growth but may increase federal deficits. In Section 1.11004, titled Extension of Deduction for Foreign-Derived Intangible Income and Global Intangible Low-Taxed Income, the bill extends deductions for foreign-derived income and GILTI, set to expire after 2025. These help U.S. companies, including rural exporters, compete globally by lowering taxes on foreign earnings. For a small agricultural exporter, this could mean thousands in tax savings, boosting competitiveness. However, it primarily benefits larger firms and may reduce tax revenue. In Section 111005, titled Extension of Base Erosion Minimum Tax Amount, the bill extends the TCJA's Base Erosion Anti-Abuse Tax, or BEAT, which targets large multinationals shifting profits abroad. Set to expire, this tax would vanish in 2026. Keeping it ensures big corporations pay a minimum tax, indirectly leveling the playing field for small rural businesses. It won't directly affect Main Street, but it could increase federal revenue to fund other programs. Part 2. Additional tax relief for rural America and Main Street. This part introduces new tax breaks to help rural businesses and communities grow, from farms to local manufacturers. In Section 111101, titled Special Depreciation Allowance for Qualified Production Property, the bill creates a new depreciation allowance for property used in production, like manufacturing or farming equipment. No such targeted allowance exists in 2025. This lets rural businesses deduct more costs up front, so a farmer buying a $100,000 harvester could save $20,000 in taxes immediately. It spurs investment but may reduce federal funds. In Section 111102, titled Renewal and Enhancement of Opportunity Zones, the bill extends and improves Opportunity Zone tax benefits, set to expire after 2025. These zones offer tax deferrals for investments in distressed rural areas. The bill enhances incentives, potentially increasing capital flow to small towns. If you invest in a local business, you could defer taxes on gains, saving thousands. It revitalizes communities but risks favoring wealthy investors if not targeted well. In Section 111103, titled Increased Dollar Limitations for Expensing of Certain Depreciable Business Assets, the bill raises the Section 179 expensing limit, currently about $1 million in 2025, and indexes it for inflation. This lets small businesses deduct more equipment costs immediately. For example, a rural mechanic expensing a $50,000 lift could save $10,000 in taxes. It's a big win for small shops but may impact federal revenue. In Section 111104, titled Repeal of Revision to De Minimis Rules for Third-Party Network Transactions, the bill repeals the 2025 rule lowering the 1099-K reporting threshold to $600 for payment platforms like Venmo. Current law requires reporting only above $20,000. This spares small sellers, like rural crafters, from extra tax paperwork, saving time and stress. It simplifies compliance but could reduce IRS oversight. In Section 111105, titled Increase in Threshold for Requiring Information Reporting with Respect to Certain Payees, the bill raises the threshold for 1099 MISC and 1099 NEC reporting, currently $600. This reduces reporting for small transactions, so a rural freelancer getting small gigs won't face as many tax forms. It eases burdens but might make tax evasion easier, impacting revenue. In Section 111106, titled Repeal of Excise Tax on Indoor Tanning Services, the bill eliminates the 10% tax on tanning services, in place since 2010. This tax adds costs for small salons, especially in rural areas. Repealing it could save a salon thousands annually, lowering prices for customers. It helps small businesses but loses revenue and may raise health concerns. In Section 111107, titled Exclusion of Interest on Loans Secured by Rural or Agricultural Real Property, the bill excludes interest on rural or agricultural loans from taxable income. No such exclusion exists now. This could save farmers or rural homeowners thousands on taxes for loans funding land or equipment, making farming more viable. It's a targeted boost, but reduces tax revenue. In Section 1-11108, titled Treatment of Certain Qualified Sound Recording Productions, the bill allows expensing for certain sound recording costs not currently allowed. This helps rural studios or musicians deduct production costs up front, saving hundreds or thousands. It supports local artists but has a niche impact and may cost revenue. In Section 1-11109, titled Modifications to Low-Income Housing Credit, the bill enhances the low-income housing tax credit, increasing funding for rural affordable housing. Current credits are limited, making projects hard to finance. This could mean more apartments in small towns, helping low-income families find homes. Developers benefit, but it increases federal spending. In Section 1-11110, titled Increased Gross Receipts Threshold for Small Manufacturing Businesses, the bill raises the gross receipts threshold for simplified accounting methods, currently $25 million. This lets more rural manufacturers use cash accounting, reducing paperwork and taxes. A small factory could save thousands, but it may complicate IRS enforcement. In Section 1-11111, titled Global Intangible Low-Taxed Income Determined Without Regard to Certain Income Derived from Services Performed in the Virgin Islands, the bill adjusts GILTI rules to exclude Virgin Islands service income. This niche change helps businesses with operations there. Potentially rural exporters save on taxes. It's narrow but could reduce revenue. In Section 1-11112, titled Extension and Modification of Clean Fuel Production Credit, the bill extends and tweaks the Clean Fuel Production Credit, set to expire. This supports rural biofuel producers, offering tax breaks for sustainable fuels. A small ethanol plant could save thousands, boosting green jobs, but it costs federal funds and needs clear rules. Part 3. Investing in the Health of Rural America and Main Street. This part focuses on improving healthcare access in rural areas, starting with hospitals. In Section 1-11201, titled Expanding the Definition of Rural Emergency Hospital under the Medicare Program, the bill broadens the definition of rural emergency hospitals, allowing more facilities to qualify for Medicare funding. Current law limits eligibility, leaving some rural hospitals underfunded. This could save struggling hospitals, ensuring you have local emergency care. It's critical for rural health but increases Medicare spending. We've explored how this bill supports families, workers, and rural communities. Now let's tackle the final sections. Subtitle C, which aims to prioritize working families over elites and curb fraud, and Subtitle D, which addresses the national debt limit. This is where the bill gets bold, so let's dive in. Subtitle C, Make America Win Again. This subtitle shifts focus to reforming tax credits, tightening benefits for certain groups, and cracking down on waste, all to put working families first. Part 1. Working Families over Elites. This part terminates or restricts tax credits, especially for energy and elites, to redirect benefits to everyday Americans. In Section 1-12001, titled Termination of Previously Owned Clean Vehicle Credit, the bill ends the tax credit for used clean vehicles. In 2025, buyers of used electric or hybrid cars can claim up to $4,000. This bill eliminates it, so if you're planning to buy a used EV, you'll lose that tax break, potentially adding thousands to your costs. It aims to simplify the tax code and focus on broader relief, but it may slow EV adoption and hurt middle-class buyers. In Section 1-12002, titled Termination of Clean Vehicle Credit, the bill terminates the credit for new clean vehicles, currently up to $7,500. This means new EV or hybrid buyers won't get tax help, increasing costs significantly. It prioritizes other tax cuts but could dampen the clean vehicle market, affecting manufacturers and buyers. In Section 1-12003, titled Termination of Qualified Commercial Clean Vehicles Credit, the bill ends the credit for commercial clean vehicles, up to $40,000 in 2025. Businesses buying electric vans or trucks lose this break. raising costs for fleets. It streamlines taxes but may slow green business investments. In Section 1.12004, titled Termination of Alternative Fuel Vehicle Refueling Property Credit, the bill eliminates the credit for installing EV chargers or alternative fuel stations, currently up to $30,000 for businesses. This cuts support for charging infrastructure, potentially saving you installation costs but limiting EV convenience, especially in rural areas. In Section 1.12005, titled Termination of Energy-Efficient Home Improvement Credit, the bill ends the credit for energy-efficient home upgrades, like windows or insulation, up to $1,200 in 2025. Homeowners lose tax help for green renovations, increasing costs for upgrades. It simplifies taxes but may discourage energy savings. In Section 1.12006, titled Termination of Residential Clean Energy Credit, the bill terminates the credit for solar panels or geothermal systems up to 30% of costs. This ends tax breaks for home renewable energy, so installing solar could cost thousands more. It focuses on other priorities but slows clean energy adoption. In Section 1.12007, titled Termination of New Energy-Efficient Home Credit, the bill ends the credit for builders of energy-efficient homes up to $5,000 per home. This raises costs for eco-friendly construction, potentially increasing home prices. It streamlines taxes but may reduce green housing options. In Section 1.12008, titled Phase Out and Restrictions on Clean Electricity Production Credit, the bill phases out and limits the credit for clean electricity production like wind or solar farms. In 2025, this credit supports renewable projects. The phase-out reduces tax breaks, raising costs for producers and possibly energy prices. It prioritizes fiscal savings, but could slow clean energy growth. In Section 1.12009, titled Phase-Out and Restrictions on Clean Electricity Investment Credit, the bill phases out the investment credit for clean energy projects. This reduces funding for new renewable facilities, impacting developers and potentially raising electricity costs. It aims to cut spending but may hinder green goals. In Section 1.12010, titled Repeal of Transferability of Clean Fuel Production Credit, the bill ends the ability to transfer clean fuel production credits to other taxpayers. Currently, producers can sell credits for cash. This restricts flexibility, potentially hurting small biofuel firms, especially rural ones, but simplifies tax rules. In Section 1.12011, titled Restrictions on Carbon Oxide Sequestration Credit, the bill limits the credit for carbon capture and storage. In 2025, this credit supports projects reducing emissions. Restrictions cut tax breaks, raising costs for carbon capture, which could slow environmental progress but save federal funds. In Section 1.12012, titled Phase Out and Restrictions on Zero-Emission Nuclear Power Production Credit, the bill phases out the credit for zero-emission nuclear power. This reduces support for nuclear plants, potentially increasing energy costs or reliance on fossil fuels. It cuts spending but may challenge clean energy goals. In Section 1.12013, titled Termination of Clean Hydrogen Production Credit, the bill ends the credit for clean hydrogen production up to $3 per kilogram in 2025. This stops tax help for hydrogen projects, raising costs for a growing industry. It simplifies taxes but could stall green innovation. In Section 1.12014, titled Phase Out and Restrictions on Advanced Manufacturing Production Credit, the bill phases out credits for manufacturing clean energy components, like solar panels. This cuts support for U.S. factories, potentially raising costs or shifting production abroad. It saves money but may hurt domestic jobs. In Section 1.12015, titled Phase Out of Credit for Certain Energy Property, the bill phases out credits for specific energy equipment, like fuel cells. This reduces tax breaks for niche technologies, increasing costs for adopters. It streamlines taxes but could slow specialized energy markets. In Section 112016, titled Income from Hydrogen Storage, carbon capture added to qualifying income of certain publicly traded partnerships treated as corporations, the bill taxes hydrogen and carbon capture income for certain partnerships as corporate income. Currently, this income may qualify for tax advantages. This increases taxes for these entities, potentially raising costs for green projects but boosting revenue. In Section 112017, titled Limitation on Amortization of Certain Sports Franchises, the bill restricts tax deductions for sports franchise purchases. In 2025, owners can amortize costs over time. This limits deductions, increasing taxes for wealthy owners but having little impact on most Americans. It targets elites and raises revenue. In Section 112018, titled Limitation on Individual Deductions for Certain State and Local Taxes, etc., the bill extends the TCJA's $10,000 cap on state and local tax deductions, set to expire. This limits tax breaks for high earners in high-tax states, keeping your taxes higher if you're affected. It maintains fairness but may hit affluent households. In Section 112019, titled Excessive Employee Remuneration from Controlled Group Members and Allocation of Deduction, the bill limits deductions for excessive executive pay across corporate groups. Current law caps deductions at $1 million per executive. This tightens rules, raising taxes for big firms, but not small businesses. It targets elite compensation and boosts revenue. In Section 112020, titled Expanding Application of Tax on Excess Compensation within tax-exempt organizations, the bill broadens the tax on excessive pay at tax-exempt entities, like nonprofits. Currently, it applies narrowly. This increases taxes on high earners at charities, ensuring fairness, but possibly deterring talent at nonprofits. In Section 112021, titled Modification of Excise Tax on Investment Income of Certain Private Colleges and Universities, the bill adjusts the tax on endowment income for wealthy universities, currently 1.4%. This tweaks revenue from elite institutions, minimally affecting students but boosting federal funds. In Section 112022, titled Increase in Rate of Tax on Net Investment Income of Certain Private Foundations, the bill raises the tax on private foundation investment income, currently 1.39%. This increases costs for wealthy foundations, raising revenue but possibly reducing charitable grants. In Section 112023, titled Certain Purchases of Employee-Owned Stock Disregarded for Purposes of Foundation Tax on Excess Business Holdings, the bill exempts some employee stock purchases from foundation taxes. This encourages worker ownership, benefiting employees at small firms but having a niche impact. In Section 112024, titled Unrelated Business Taxable Income Increased by Amount of Certain Fringe Benefit Expenses for which deduction is disallowed, the bill taxes fringe benefits at nonprofits as unrelated income. This raises costs for organizations offering benefits, potentially reducing perks but increasing revenue. In Section 112025, titled Name and Logo Royalties Treated as Unrelated Business Taxable Income, the bill taxes nonprofit royalties from names or logos. Currently, these may be exempt. This increases taxes for universities or charities licensing brands, raising revenue but possibly cutting their budgets. In Section 112026, titled Exclusion of Research Income, Limited to Publicly Available Research, the bill limits tax-exempt research income to public research. Currently, broader research may qualify. This taxes private research, raising costs for nonprofits but ensuring only public benefits get breaks. In Section 112027, titled Limitation on Excess Business Losses of Non-Corporate Taxpayers, the bill extends the TCJA's cap on non-corporate business losses, set to expire. This limits deductions for high earners with large losses, raising their taxes but not affecting small businesses. It targets wealthy investors. In Section 112028, titled 1% Floor on Deduction of Charitable Contributions Made by Corporations, the bill adds a 1% floor to corporate charitable deductions. Currently, no floor exists. This slightly reduces corporate tax breaks for donations, encouraging giving but raising revenue. In Section 112029, titled Enforcement of Remedies Against Unfair Foreign Taxes, the bill strengthens measures against unfair foreign taxes on U.S. businesses. This protects exporters, including rural firms, from double taxation, potentially saving thousands. It boosts competitiveness, but may strain trade relations. In Section 112030, titled Reduction of Excise Tax on Firearm Silencers, the bill lowers the tax on silencers, currently $200. This reduces costs for lawful gun owners, saving hundreds in taxes. While it supports Second Amendment interests, critics may raise concerns about safety and law enforcement visibility. In Section 112031, titled Modifications to De Minimis Entry Privilege for Commercial Shipments, the bill adjusts the duty-free threshold for small imports, currently $800. This could raise costs for low-value imports, affecting small businesses but protecting domestic sellers. In Section 112032, titled Limitation on Drawback of Taxes Paid with Respect to Substituted Merchandise, the bill restricts tax refunds for substituted exported goods. This tightens rules, raising costs for exporters but increasing revenue and ensuring fairness. Part 2. Removing taxpayer benefits for illegal immigrants. This part restricts taxpayer-funded benefits to citizens and legally present individuals, aligning with existing federal eligibility rules and reinforcing documentation requirements. In Section 112101, titled Permitting Premium Tax Credit Only for Certain Individuals, the bill restricts the premium tax credit to citizens and legal residents. In 2025, some non-citizens may qualify. This cuts subsidies for others, saving funds but potentially leaving some uninsured. In Section 112102, titled Certain Aliens Treated as Ineligible for Premium Tax Credit, the bill explicitly bars certain aliens from the credit. This reinforces restrictions, reducing federal costs but limiting health access for some. In Section 112103, titled Disallowing Premium Tax Credit, during periods of Medicaid ineligibility due to alien status, the bill denies credits during Medicaid ineligible periods. This tightens rules, saving money but reducing coverage options. In Section 112104, titled Limiting Medicare Coverage of Certain Individuals, the bill restricts Medicare for some non-citizens. Currently, legal residents may qualify. This cuts costs but limits health access for affected groups. In Section 112105, titled Excise Tax on Remittance Transfers, the bill imposes a tax on money sent abroad, likely targeting immigrant remittances. No such tax exists in 2025. This could raise costs for families sending money, generating revenue but affecting low-income households. In Section 112106, titled Social Security Number Requirement for American Opportunity and Lifetime Learning Credits, the bill requires SSNs for education credits. Currently, ITINs may qualify. This restricts benefits to citizens and legal residents, saving funds but limiting education access. Part 3. Preventing Fraud, Waste, and Abuse. This part cracks down on improper payments and tax fraud to protect taxpayer dollars. In Section 112201, titled Requiring Exchange Verification of Eligibility for Health Plan, the bill mandates stricter verification for exchange plans. Current law has looser checks. This reduces fraud but may delay coverage for some. In Section 112202, titled Disallowing Premium Tax Credit in Case of Certain Coverage. Enrolled in during special enrollment period, the bill limits credits for special enrollment errors. This tightens rules, saving money but potentially denying valid claims. In Section 112203, titled Eliminating Limitation on Recapture of Advance Payment of Premium Tax Credit, the bill removes caps on repaying excess premium credits. Currently, repayment is limited for low-income households. This increases repayments, recovering funds but hitting lower earners harder. In Section 1.12204, titled Implementing Artificial Intelligence Tools for Purposes of Reducing and Recouping Improper Payments under Medicare, the bill uses AI to detect Medicare fraud. No such mandate exists now. This saves billions, but requires investment and oversight. In Section 1.12205, titled Enforcement Provisions with Respect to COVID-Related Employee Retention Credits, the bill strengthens enforcement for COVID retention credits. This recovers improper claims, saving funds but increasing audits for businesses. In Section 1.12206, titled Earned Income Tax Credit Reforms, the bill reforms the EITC to reduce fraud, possibly tightening eligibility. This protects the program, but may exclude some eligible low-income workers. In Section 1.12207, titled Task Force on the Termination of Direct File, the bill creates a task force to end the IRS Direct File program, a free filing option in 2025. The IRS Direct File program, a pilot offering free online tax filing to individuals, would be phased out under this provision, returning more reliance to private tax software providers. This could raise costs for low-income filers and reduce free filing options. In Section 1.12208, titled Postponement of Tax Deadlines for Hostages and Individuals Wrongfully Detained Abroad, the bill delays tax deadlines for hostages. This offers relief for rare cases with minimal fiscal impact. In Section 1.12209, titled Termination of Tax-Exempt Status of Terrorist Supporting Organizations, the bill revokes tax-exempt status for groups tied to terrorism. This ensures fairness but requires careful enforcement to avoid misuse. In Section 1.12210, titled Increase in Penalties for Unauthorized Disclosures of Taxpayer Information, the bill raises penalties for IRS data breaches. This protects your privacy but may burden honest errors. In Section 1.12211, titled Restriction on Regulation of Contingency Fees with Respect to Tax Returns, etc., the bill limits IRS rules on contingency fees for tax preparers. This protects preparers but may increase risks of shady practices. Subtitle D, Increase in Debt Limit. This subtitle addresses the national debt ceiling to keep the government running. In Section 1.13001, titled Modification of Limitation on the Public Debt, the bill raises the federal debt limit, currently around $36 trillion in 2025. This provision raises the legal cap on how much the federal government can borrow, ensuring programs like Social Security, veterans' benefits, and tax refunds continue uninterrupted. While it prevents default, critics warn it could fuel long-term debt growth, potentially impacting future taxes or services. For you, it means stability in federal programs, but critics warn it fuels long-term debt growth, potentially impacting future taxes or services. As of today, the one big, beautiful bill has passed the House of Representatives but has not yet become law. It must still be considered and passed by the Senate, and any changes made during that process could revise or remove key provisions. We will continue to monitor its progress and provide updates as it moves through the legislative process. That's the breakdown of the one big, beautiful bill. From tax cuts to healthcare improvements, this could reshape your financial future. Share your thoughts in the comments and like and subscribe for more policy breakdowns.